In terms of the yield curve, and you're absolutely right, Matt, when you mentioned that everyone's out there buying the TLT, you see the expansion of the number of ETFs created. Everyone's saying, I got to go out, I got to get long bonds because this is a kind of once in a lifetime opportunity to buy them. And my point was, yeah, sure, for trade, it might work, meaning that if the economy rolls over or we get a market crash, you might make money on that long end trade. But if you think about it from a longer term perspective, and you accept that we've changed the environments that we're in, and we're not going back to that kind of post GFC, pre-COVID 0% rates, and we're going to be in an environment with higher rates for longer, what you realize is that even if the Fed goes and, let's say, reduces rates by 200-300 basis points, let's say they take the kind of Fed funds from 5 down to 2 or 3. If you look at what happens as they ease, the yield curve steepens. And if you go look at the 230 over time, during recessions, that can steepen out to kind of 400 basis points. So we could have a situation where you might get the call right on the economy, or you might get the call right on the market crash, and you think I should buy bonds. And what happens is the Fed comes, reacts to it, and the long end, instead of going down in yield, actually rises in yield because the market gets nervous about kind of the ensuing inflation that might come from their easing.
Well, and yesterday we were talking about if you'd bought the 30-year in the heart of the pandemic in 2020, it's now worth 46 cents on the dollar. And yeah. I don't know if anybody, well, certainly retail investors don't think about the fact that you could lose that much of your capital on treasuries, right? And I get that it's long duration, but hey, you bring up another interesting point in TLT, which is I think it's 20 years plus, right? ETF, Treasuries ETF. So right. 20 years and longer duration. We've just seen incredible inflows there. And I saw a piece in the Bloomberg story on Michael Hartnett today pointing out that Treasury funds took in $4.6 billion last week, and that's their 34th straight week of inflows. How is it possible for these funds, and I guess they're mostly ETFs, I'm not sure, to take in so much money, so many people buy them, and yet the price of the underlying asset goes down, 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 down?
Well, the government bond market is huge. Well, so when you think about the amount that the TLT's done, it's just a drop in the bucket. That's a tiny little market, and they're a minute player in terms of what has happened. And the dynamics in terms of the kind of market expectations about what's occurring in terms of the higher for longer is just kind of overwhelming things right now, Matt. So it's just, in essence, for the longest time, everyone thought that there was going to be a recession. If you go and you look back at like the Bank of America surveys at the beginning of the year, they were convinced that there was going to be all sorts of, an imminent recession because of the higher rates. And what you're seeing now is that the big kind of fund managers, the ones that were making those bets, are finally giving up on it. They've accepted the higher for longer from the Federal Reserve. And it was the dot plots that did it, in essence. I'm actually shocked that was the kind of the trigger, the catalyst for it. But was when those dot plots came out, they came to the realization, hey, the Fed's not going to cut like we thought. The economy is going to be stronger than we think. Therefore, we priced the long end all wrong.
Hey, Kevin, one of the many things I like about your website, The Macro Tourist, is right up front, you tell people, all I bring to the party is 25 years of mistakes. And boy, I can relate to that. So do I just go stick my, vast, resources into the 2-year Treasury at 5.09% and just sit there and clip coupons?
Well, that is a great trade in terms of if you're talking about cash. And I think you need to kind of differentiate between people that are trading in terms of investing just on a cash basis versus those that are speculating. And one of the things that, Alec Gurevich has this line that he says that easing is steepening. And I think that's a great line. And that goes back to my point about the fact that even if we get the Federal Reserve lowering rates, you might not actually find yourself at the long end doing that great. Now, if you just paid cash, it's no big deal. And one of the things that I think a lot of people are missing in terms of when they start thinking about shorting these bonds, when you were shorting a 10-year at 2%, when it went from 2 to 2.5 in terms of yield, you only earned 2% in the meantime, in terms of to pay back the duration loss, let's say, from the capital gain, the going down. Now at 5%, these things carry a lot more, a lot more positively in terms of if you're just owning it outright. However, if you're buying it on margin, meaning if you're financing it, you're still financing it at 5.4% or whatever the overnight repo is. And after today's announcement, it looks like the Fed's going to go and most likely going to raise rates again. And so the levered buyers are the ones that are really hurting. And that's really what we need to see. We need to see the long end move to a point where they can finance it and hold these things without losing money. And until we get there, I think that there's going to be some continued pain. So on the one hand, if you're just buying it for cash, nothing wrong with going and owning the 2-year. But if you're speculating, I think that you really need to wait for the fact is until these carry positively, it's going to be tough slugging.